Okay guys, today we're going to be looking at investment properties in Peterborough through analyzing cap rates of recent sales. Today's video is going to have a goal of giving you an idea what kind of cap rates properties are trading for in Peterborough, what the average is, and a little bit of insight about why some properties are trading drastically above or drastically below the averages so that you can make an informed decision on your next income property purchase. Okay guys, so Peterborough cap rates. What is a cap rate? Cap rate is short for capitalization rate. It's a commonly used real estate investment metric, and it doesn't give you an absolute view into what the return on investment on a property is going to be or how profitable it would be, but it's used to level out the playing field and gauge comparative investments against each other. Quick overview, the capitalization rate. I'm not going to go much further into what the cap rate is because there's all kinds of good information out there, both on the internet and in written text about what the cap rate is and what its shortcomings are. What I'll say at a glance is that the cap rate is simply the net operating income of a property divided by the purchase price or market value expressed as a percentage. So it gives you a good idea into the relationship between how much you're paying for the net operating income stream of that property. Data discussion, just to quickly go over where I got my numbers from that we're going to be looking at today. We analyzed 17 properties that were sold in the last 6 months in Peterborough from duplex upwards, and of that data, there was some that we elected early in the analysis to leave out because they were too far outside of the normal range and they didn't represent fair market sales, or they were sort of odd figures and they skewed the data. And then once we got those 17 done, we pared it back down to 13 total that got used because they were the most representative of normal trading activity. Okay guys, so you can see I've got this broken down by duplexes, triplexes, and 4+ unit properties. Before we dive into breaking down what the cap rates were on the properties that we analyzed, I want to go over the assumptions. There's always a few unknowns, or there's a bit of room for flexibility in these numbers, as anybody who's derived their own cap rates for properties knows that when it comes to maintenance and repairs and management, these two in my mind have a large room for interpretation, because the maintenance and repairs that have been reported on a listing agreement for a property, say for example, if they're extremely low, that doesn't necessarily mean that they're going to be extremely low for you, because it could just represent that the past owner neglected a bunch of maintenance and it's going to get dumped on you, and vice versa. If the maintenance and repairs on a property are showing extremely high, that could mean that that owner has done all the repairs they needed to do. They over improved the property and there's going to be nothing left for you to do. So your maintenance and repairs are going to be a lot lower in the foreseeable future of your ownership. Also, when it comes to management, there's a potential that they're showing 3% for management, but they're doing it all in-house. They're just including their admin cost and some staffing costs. But when you go to take the property over, you're going to hire a property manager between 5 to 10% of gross income. So we flattened the field on that stuff and put 6% for repairs and maintenance. That includes capital expenditures, and 5% for management, and that's of the gross potential rent, or the reported gross rent figures on this. So getting into the numbers here, duplexes. We analyzed 4 duplexes. The average cap for duplexes was 4.36. The low figure in that pile was 3.16, and the high was 5.64. Triplexes, analyzed 6 triplexes. The average was 4.95. So as you can see already, that's a better cap rate, or potentially a better rate of return than the average duplexes. The low was 3.21 and the high was 6.77. So that's quite above the average there. The 4+ unit properties, we analyzed and kept 3. The average cap was 5.63%, the low was 5.13, and the high was 6.53. What's significant when we look at this? First off, I'm going to say one thing that stands out right off the hop is that the 4+ unit properties have the highest cap out of all of these, and it exceeds what I deem to be the city average of right around 5%. So this has to come with a bit of an asterisk, because only having 3 properties in this stack, and now there's a good reason for that, because there's not a lot of properties that sell in our city that are multi-unit larger than 4 units, because there's just not a lot of activity. There's not a lot of sellers coming to the market in that range. And secondly, when those properties are sold, there hasn't always been a full set of data available in terms of the operating statements. So when we look at that, 4+ units, it's suggesting to us that there's a greater ROI, potentially a greater return on investment in 4+ unit properties over the smaller units, duplex and triplexes. But that kind of goes against the conventional wisdom that buyers might be willing to take a lower rate of return to have a bigger investment, a larger property, and there should be a bit of so to speak, cap rate compression as the units go up on these properties, but in our set there isn't. What else is significant about these numbers, and what do they mean for you as a buyer or a seller? One big thing that I noticed is the deviations from the average in each category are fairly significant. So the average duplex trading at 4.36%, and the low down to 3 and a high up to 5.64, some pretty good fluctuation on each side. Same goes for each category. The big question is, why are some sellers willing to sell their property at a lower price and providing a higher cap rate to buyers? In what situations? And in what situations are these buyers willing to accept these very low cap rates? So a lot of factors have to be considered in this. And again, the cap rate falls short of some things such as the time value of money and financing cost involved with the purchase. But in general, when I looked at why buyers received above average cap rates and when they were willing to take below average cap rates, was these factors. So for high deviations, why buyers got the higher cap rates is location and market rents. So when it comes to location, almost all of the properties that I looked at that were above the average by any significant amount, they were in less desirable locations. Typically they're around the downtown core, where the tenant demographic might have been less ideal for the landlord. They might have anticipated more management being involved, potentially more turnover, potentially more damage to the unit, those types of things. And they commanded a premium to take that building on. So they got higher ROI, but they were potentially paying for it, or they were willing to accept some risk for that. The second is market rents. Almost unanimously, the buildings that posted well above average cap rates had just renewed their leases, signed new leases, or had vacant units that were being considered at current market rents in the gross income figures. So for one, these properties were receiving great income because they were beating most of the other properties in terms of the average rent per unit they were receiving. So the net operating income was higher per unit, but also the buyers were discounting it at a higher rate. So therefore they received a higher cap rate because they knew that there was no further upward potential for the net operating income in the future. That is to say, as long as everything had been done on the expense side of the equation of net operating income, all of the metering was separated, it was possible, and they had done whatever they could to reduce their bills, there's no other way to increase net operating income in the long-term future other than the regulated rent increases, because the rents were already as high as they could be. So yeah, they're getting great rents now, they're getting a great return on investment, but there isn't much potential for increasing that NOI and then therefore increasing their future sale price based off that cap rate. Low deviations. Why were some buyers willing to accept well below average cap rates? In general, as a whole, I found the most standout factors to be building age and net operating income upside. So the reverse. Building age, of course, the buildings had to be in a fair area, not in a totally undesirable area, but building age seemed to be a very big factor. Some of the properties in this set of analyzed properties were 100 to 150 years old. In general, the ones that were receiving the lowest cap rates, therefore people were paying the highest price to receive the lowest amount of net operating income, were buildings that were from the 50s and onwards, some of them from the 70s and that type of era, where these were sort of square box, purpose-built, multi-unit dwellings that had modern mechanical systems and all in all stable buildings. You could take similar properties of similar repair that had their floors redone, fixtures and bathrooms redone, but the buildings were older and they inherently had the stone foundation issues that can't be rectified, dirt floors, those type of things, crawl spaces, and older or some obsolete mechanical systems that were hard to remedy. And those were not the types of properties that were appearing in these low cap rates. They were normally of a newer age. And then finally, net operating income upside. These properties that posted the low, below average cap rates typically had good potential for net operating income increases in the future in one of two ways. Either they were anticipating tenant turnover to renew some leases that were old and had been subject to rent controls for too long, and they were well suppressed below current market rents. So take, for example, if you had a 9-unit building and a lot of the rents in there were well below the current market rents you could receive, the purchaser might be willing to take a below market cap rate, knowing that over time, as those units turn over, that they're going to receive current market rents and they're going to see a significant increase in their ROI, or their net operating income. And then lastly, some of them had potential to shift the equation on the other side, on the expense side of the equation, by separately metering or in any way reducing the expenses. So there were some properties out there that were still taking on hefty bills with baseboard heat, and the owner saw potential to switch the way the mechanicals were set up or rejig the leases so that in the future the tenants would be responsible for the utilities, and then therefore they could potentially receive some increase in NOI and further their cap rate, better their cap rate in the future. Okay guys, hopefully you found that useful. Let me know if there's anything that I went over too quickly or you think that I didn't cover enough. Let me know if there's anything that you didn't quite care to hear about in the next videos. And I hope to do one that compares Peterborough to more of the major Ontario cities in the future. If you like this video, please give it a like. It really helps to boost it and let other people see it. And consider subscribing, because I'm going to keep coming out with information like this. And thanks so much for watching the video, guys.